In this presentation, we will discuss items that would be excluded from gross income, including fringe benefits. Now, we're considering the first line here, the income line, and typically when we're thinking about the income line, usually we're thinking about those items that would be included in the income line, and usually we would have some documentation to show us that they would be included in the income line. Now we're thinking about items that are excluded from the income line, which means we're probably not going to have documentation that would include these items. So why do we need to know about these items? Well, we need to know about these items because one, we might have questions about them. We might have some of this kind of items that we would consider income because really they are income. And we know the general rule for the income tax, the IRS code, is that if you received something that is income, it is income unless specifically excluded. So just because we didn't get documentation for it, which we typically would not for these types of items, if it's going to be excluded, then that doesn't mean that we don't need to include it. So we might have questions about it on our own income. We might have clients that ask us about these items. They say, hey, I got this kind of money or this kind of benefit. I know it's some kind of income. It's a benefit to me. It's been a benefit in this time period. I didn't get any documentation to report it. Do I have to report it? So that's one reason we need to know about it. The second is that although it's excluded, and when you do the tax preparation, it's too late to basically have any kind of planning or take any kind of actions on those things because it's already the tax preparation time. But you want to be aware of these things as well because they could be a benefit that you can give to yourself or clients by advising on these types of things. So if you think about something, any type of thing where you're saying, hey, especially when it's an employer-employee relationship, if you can say, hey, your employer can provide you this if you think it's valuable, and it might be some way that you can get paid, you can get money, you can get compensation that you do not have to include as income on the tax return. That means it has no added cost to the employer because they're still paying you whatever that is. So in other words, they can allocate some portion of your revenue to basically a fringe benefit possibly, which means you still get the revenue and the benefit, you still get the income. And if you don't have to include it on income taxes, you don't pay taxes on it, which would be a benefit. And so the major thing that would be the case for, one of the big examples is like a 401k plan, where the employer could put some of your wages into the 401k plan, provide you that benefit, and put it into a 401k plan, which is going to be exempt from the income up top. And if that's the case, you still got the income, but you don't have to pay taxes on it because the IRS code has a legal exemption basically for the retirement plan, the 401k. Therefore, it's kind of like you're getting a bigger benefit for the same amount of income. It doesn't cost the employer any more, and you're getting more of a benefit for it. So that's the kind of idea. Now, most employers, of course, know about a 401k plan. If they don't have a 401k plan, you can ask for that because that would be a huge benefit to the employees. And it does cost with the setting up of a 401k plan, but the actual payments out to the employees, if it was determined whether it should be paid out in terms of wages that would be subject to tax, and these kind of items that you can put into a 401k plan, which would not be subject to tax if you can put it into the 401k plan, then it would be a benefit to the employees because of that tax benefit. So fringe benefits, you could take a look at publication 15B. We should have a link to that, and you can find that on the IRS website for more details on these types of fringe benefits. So any of these items that look interesting to you, you can look over those items and maybe consider those items with yourself and your employer, or possibly with clients as well for tax planning purposes. So we have the exclusion rules that apply to fringe benefits. These rules exclude all or part of the value of certain benefits from the recipient's pay. So that's the point. We want to basically earn revenue and legally not have to include it in the federal income taxes, which means we're getting more benefit from the revenue that we are receiving without any added cost to the employer, which is a great deal. So in most cases, the excluded benefits aren't subject to federal income tax withholding, Social Security, Medicare, federal unemployment tax, or Railroad Retirement Tax Act. Taxes aren't reported on Form W-2. Now, that means for reporting purposes, notice that these fringe benefits, oftentimes if it's not going to be included, something, let's say like a 401k plan, that will already be reflected in the documentation. So if it's something that is not going to be included in income, hopefully by the tax preparation time, the documentation already reflects that. And all we need to do is basically be able to explain to the client or ourselves for our own understanding as we enter this into the system, why or why not that documentation is the way it is. So with regards to a W-2, we can say, well, your income is higher, right? The income in box 1 is higher then it actually says in box 1 because you had this fringe benefit, for example, a 401k plan that is not subject to federal income taxes, which is reflected on the box 1 of the W-2. That's why box 1 of the W-2 is going to be greater than your Medicare wages. You got wages that aren't included in box 1. So the actual data input for us, hopefully at the point in time that we enter the tax return, will be fairly straightforward, because this information, the fringe benefits that won't be included in income, should be reflected in the W-2. And of course, the IRS is going to give pressure to the payers to give the proper documentation, which is mainly the employer. So if there's a fringe benefit, the IRS wants to pressure the employer to properly report that on the statement that's going to report income, which is generally going to be the W-2 statement. So publication 15B discussed exclusion rules for the following fringe benefits. So I'm just going to give a list of fringe benefits. If you want to have more information on them or look into a specific one, you can go into publication 15B. We'll provide it here. You can go into the IRS website and find it as well. Accident and health benefits. We have the achievement awards, adoption assistance, athletic facilities, de minimis minimal benefits. So those are going to be just because there's a dollar limitation. They're smaller benefits. Dependent care assistance, which could be useful depending on the employer we have. Could be something that could be very beneficial to certain organizations. Employee discounts. So when you talk about, the classic example is an airline or something like that, and you have the flights on the airline. Can you get discounts on the flights or whatnot, that kind of thing, depending on the type of industry you're in. Employee stock options, employer provided cell phones, which can be a big thing, in the current environment. Group term life insurance coverage, health savings accounts, the HSAs, lodging on your business premises, meals, no additional cost services, retirement planning services, transportation, commuting benefits, tuition reduction. So any kind of education expense that could possibly be picked up if your goal is to continue your education. And you can talk to the employer possibly about giving part of your compensation towards education if it's something that could be excluded to a certain point from income. That could be something that would be beneficial. Working condition benefits. So then we have other non-taxable income. These are going to be other kind of items that are not generally included in income. And again, if they're not included in income, then you're typically not going to get documentation on it, but you're going to get questions by yourself and by clients about it, and you want to have a general idea of it. The first one is gifts and inheritance. Now, so the question here would obviously, well, what would happen if I inherited money? Someone died, I got money, inherited money. That would seem to be income to me. But typically what we think about income is usually something where you did something and then you received something. So income is usually a transaction. So the general rule is that if you got money, if you got money or a benefit, a car or something like that, you must have done something for that. That's a general rule in an exchange kind of environment. And that would typically be triggering income. In the case of someone dying, what's really happening is they're giving you the money, right? There's no exchange happening here. One person's just giving you the money. They've already been taxed on the money because they were taxed on it under an income tax system when they earned it. When they died, they're giving it to you, and you didn't do anything to earn it. They're just giving you money. So in a true gift situation, there's no exchange, and therefore you would think no income would be related to it. So that's the general rule. So usually a gift and inheritance are kind of similar. They're basically the same thing. One's a gift. Before someone dies, no exchange happened. Gift happened. Money was given for no return. And when someone dies, they gift the money, and they're not receiving, of course, anything in return. Now, there is such a thing as a tax when someone dies, and you would call that an estate tax. You might hear it called like a death tax, right? When someone dies and you go pile their money up and the government takes some of it, and then, but that tax is going to be applied on the estate level. So they would die and they would, gather up their assets. And if they're over a fairly high dollar amount, you got to be over a pretty high, pretty well-off individual, then you may be subject to an inheritance tax or death tax. But that's usually applied to the entity, basically the estate at the point of death. And then once the government goes in and takes what they want, then the actual distribution of it after that point in time would not be taxable because it had already been taxed at the point of death at the estate level. So that would only take place, there would be a tax at that level, at the estate level, and then when the inheritance came to the individual, it wouldn't be taxable because it would already had been taxed at the estate. So that's a general rule. Now, if you get into estate taxes or something like that, you want to spend a lot more time on thinking about that, and that generally is going to be something that will be applicable if you're at higher income level individuals. The gifts are going to be similar in that there is tax consequences, but the tax consequences aren't usually at income tax consequent at the point in time of the gift. In other words, if you gift something to somebody, then it's just a gift, or if you received a gift, it's just a gift. It's not a taxable event because there's no exchange. However, if you gift over a certain dollar amount, if you gift a lot of money, then you may have a reporting requirement for it because the government is concerned that you're going to gift all your money away before you die, and they won't be able to pile all your assets up and take what they want before the inheritance tax goes away. So that means that the gift tax is going to be related to the inheritance. If you gift a lot away, they're going to take away your inheritance exemption, which means that when you die, they're gonna still want to take the money when you die. So that's really going to be applicable only for higher income individuals. General rule: if you get money, if you've just been gifted money, then it's usually not a taxable event. And if you are gifted money in terms of an inheritance, if someone dies and basically gives you their money, generally not a taxable event. So that's going to be the general rule. And again, if you get into estate taxes, then that's usually higher income individuals, and you want to look into that in more depth. Could be a complicated area. Laws change there a lot. And then we have the life insurance proceeds. So generally, if you have proceeds from life insurance, so you got money from the proceeds from a life insurance policy, typically, general rule, not something that would be included in the income. Then we have, and notice if it was, next we have the scholarships and fellowships. So if we got, kind of like free money basically for the purpose of going to school for a scholarship or fellowship, then typically that is going to be a type of compensation or type of basically income that's not included in income generally. And the idea there, of course, is to incentivize people to provide the benefit of the scholarship and fellowship. And those are kind of gifts as well, because the idea of those is there's nothing in exchange for those as well. People are gifting, in essence, money for a scholarship. And then we have qualified tuition program withholdings, money put into a qualified tuition program withholdings, compensation for sickness or injury. This is another one that would typically be, the employer would be responsible for the reporting of this. So hopefully from the tax preparation standpoint at this time, that would be properly reflected in the W-2 form. So it should hopefully be all taken care of it for us as we actually do the data input process. Child support. When we think about child support, notice if there's typically this is something that happens in a divorce situation. We'll talk more about a divorce situation later, but if there's a divorce situation, note that you might have money going from one individual to another in the divorce settlement. And that money could be characterized either as child support typically or as alimony. And if it's characterized as child support, one spouse paying another spouse in order for child support, not typically something that the receiving spouse has to report as income, and it's not something that the giving spouse would be able to get a deduction from. If it's alimony, then if it's categorized as alimony, then it's a more complex kind of situation. We'll talk a little bit more about that later. There's been recent changes to the law, but the question then there is, does the recipient of alimony have to report it in income, and does the person paying get a deduction for it? And that's more of an iffy situation under the current changes that took place basically last year, the year before. Then we have welfare. Welfare is not typically something that would be included in income. And then we have the employer-provided adoption assistance. Again, something that would be given by the employer, hopefully then reflected properly in the item that would be reporting our income or the income of the taxpayer, that being the W-2 form.